Okay, and so today we're going to be talking about the business cycle and GDP specifically. Okay, and so what the business cycle sort of is the ups and downs of business. Really, it's the idea that some years both output and employment are rising, which we call an expansion, and in other years they're falling, which we call a contraction. But basically, the business cycle sort of looks like this. And I'm going to draw an exaggerated one just to sort of make it really clear. Right? So we have that. And so what we have is sort of real GDP rising really rapidly at some times and slowing down or even falling at other times and rising really rapidly. And if we put sort of a line of best fit through this, it looks something like that, okay? And the general idea is that while a recession or while GDP might slow down or not grow very quickly in one year, the overall trend is for GDP to be increasing. Okay, so the idea is that over the long run, GDP increases, even if in the short run it kind of doesn't. Okay, and so what we have are four sort of ideas, or five really. So whenever we are above the long run trend line, we say that we're in a boom. So this is a boom, and this would be a boom, right? Anytime we're above sort of this long run trend line, we call it a boom. And anytime we're below it, we call it a bust. Okay, so a boom is when we are above the trend line. And a bust is when we are below the trend line. Okay. And then we also have these things called expansions and contractions. So an expansion, let me turn my phone on silent real quick, sorry about that. An expansion is whenever GDP is increasing. And a contraction, at least these are for the purposes of this class. Right? These are non-technical definitions. A contraction is when GDP is decreasing. Okay, and so if we're in a contraction, it means GDP is falling. If we're in an expansion, it means GDP is rising. Okay, but then we have sort of one more thing, which we call a recession. Okay, and a recession is any two or more consecutive quarters of contraction. Okay, so basically a recession is any 6 months in a row of declining GDP. Okay, but this is sort of the idea of the business cycle. Okay, and so we have sort of a cyclical view of the economy where in the long run it's going up, but there's periods where it might be going down and there's periods where it might be going up really, really quickly. But again, the general trend is, onward and upward. And it's really this red line here that economists are concerned about, okay? We're not terribly concerned with this thing here, right? We do get concerned if the boom and bust are huge, right? So the bigger these gaps are, the more concerned we become. But if they're really small, we just kind of say like, oh yeah, that's nothing to really fret over. But we do get concerned during times like the Great Depression, when the bust were very deep, or the Great Recession in 2007 to 2009, right, where again the bust was very deep and lasted for a long time. So those types of things we worry about, but generally speaking, if it's if it's close to the line, we're not that concerned about it. Okay. Now the key in this graph is GDP. Okay, and so let's sort of go over what that is. So GDP stands for gross domestic product. Okay, and the way we describe it, we typically abbreviate it as GDP because no one wants to say gross domestic product, right? It's too many syllables. And so the way we typically describe it is the total value of all the final goods and services produced in an economy over the course of 1 year. And the year, it can be a fiscal year or a calendar year. Doesn't really matter. Okay, so let's break this down a little bit. And so first, we should recognize that we are concerned with market values, not necessarily quantities. Okay, and what this means is that, prior to today, we'd talk about things like, oh, how many carrots would you eat? Or how many cars would you buy, right? We'd talk about stuff like that. But now we're concerned with sort of the total dollar value of all the things that are bought and sold. And so what we do is we convert all goods to dollars, right? We multiply by their price. And then we add all those prices or all those dollars together. And that gives us sort of a total dollar figure. Or you can think about it in terms of the grocery store. Okay, so the grocery store isn't really concerned with how many apples they sell or how many bananas they sell or how many pears they sell. They're concerned with the total number of dollars worth of food that they sell, right? And so the way you would calculate that is you'd multiply the number of things that you sell times their price, and that would give you the total number of dollars that you sold. And so now, if you understand sort of that grocery store analogy, just expand that to the entire economy, right? So now we're concerned with the total value of all the things that the U.S. economy produced in 1 year. We're not concerned with how many cars the U.S. produced or how many computers or anything like that. We're concerned with how many dollars worth of stuff we consumed or we produced, okay? The second part is that we only care about final goods, not intermediate goods. Okay, so let's do some examples. So things like houses count towards GDP. Wood does not. Right? Cars count. Steel does not. Okay? And so we count the car, but we don't count the steel that goes into making the car. And we count the houses, but we don't count the wood that went into making the house. And the reason why we do that is because if we did count the wood or we did count the steel, then the wood would actually count once as wood and then again as a house, right? And the steel would count once as steel and again as a car. And so it would be double counted. Just like when you go to a restaurant, you don't say and tell someone what you ate that day. You don't say something like, I had a hamburger and a patty, right? And buns, right? You don't say that because you already told them that you had a hamburger patty and hamburger buns by telling them that you ate a hamburger, right? And so if you were to do that, then people would think that you ate 2 hamburgers for lunch, right? But that's not true. You only ate the one, okay? So we only count the final thing, the house or the car or anything else that consumers actually buy. We don't count the things that go into making those things. Okay, and then finally, it only counts current production. Okay, so that really cool car, that really cool used car from 2003, if you bought it this year, it does not count towards this year's GDP because it was produced in 2003 and it already counted towards GDP then, right? We don't count things like anything sold on Craigslist doesn't count as production. Most things sold on eBay don't count. A few things sold on Amazon don't count, right? Those of you that are renting your textbook or bought a used copy of your textbook, that doesn't count towards GDP, right? Those of you that bought a brand new textbook, that does count towards GDP because that textbook would have been produced this year and sold to you, okay? Another way to think about GDP is to think of it as the total value or the total amount of income earned in 1 year, right, by an entire economy. And if you think back to lesson 2 when we went over the circular flow diagram, that kind of makes sense because what we were saying there, right, is that goods and services sort of flow around in this direction, right, and money went around in this direction, right? And so GDP is sort of the flow of those goods and services, or it's how many things are moving around in that circle. It doesn't matter if I measure it in terms of dollars going this way, right? If I think about the goods as dollars, right, I think about it this way, or if I think about the dollars that are being spent, right? Both of those have to be identical. The other way to think about it is that if you've ever gotten a paycheck, odds are you either spent it or you put it in the bank, right? And so there really isn't a third option. You're either going to spend the money somewhere or it's going to go into the bank. And so banking would be a financial service that you purchase, right? And spending it is obviously spending. And so GDP can also be thought about as the total amount of income earned by an economy in 1 year. Okay. Now, when it comes to GDP, there are 4 components. Okay. First, there is consumption. Okay. And consumption is basically anything that you buy and immediately use, right? You use it in some way. Okay, so consumption could be food, clothing, gasoline, pens, watches, computers, those types of things. These are all forms of consumption. But within consumption, there are 2 broad categories. The first one is called durable goods. Right? And durable goods are goods that sort of last a long time. So some examples would be, furniture, computers, cars, appliances, etc. Right? Anything that sort of lasts for a long time. Things that you buy once and you don't buy again for a long, long time. And the second category is what we call non-durable goods. Okay, so if you can't tell, economists are very boring in terms of how we name things. A durable good, well, that's durable, right? A non-durable, well, it's not, right? This will be things like food, to some extent clothing, let's see, soap, hopefully, things that you buy and you basically immediately consume and you have to buy again, right? Things that you would buy, multiple times per month, perhaps, definitely multiple times per year, right? But most people aren't buying multiple, couches or multiple computers or cars or appliances per year. Unfortunately, there's really no sort of exact science about what constitutes durable and what constitutes non-durable. Fortunately, though, if you look at something and you know what it is, the answer should be pretty obvious. If I said artwork, is that a durable or a non-durable good? Right? Odds are you guys would say like, oh, well, artwork, that lasts a long time. That's a durable good. And you'd be right. Okay. So with the distinction between durable goods and non-durable goods, it's sort of a you know it when you see it, right? And I'm willing to bet that all of you know it perfectly fine when you see it, even though I can't give you a bright line rule that tells you exactly what it is. Okay. The second component of GDP is what we call investment. Okay, an investment is anything that you sort of anticipate that will grow in value over time. It doesn't mean that it's guaranteed to grow in value over time. It just says that you anticipate that it will grow in value. Okay, anything like that. So school, to some extent, houses. Let's see, inventories of things. These are all forms of investment. Okay, and so these all count towards GDP as well. The third component is what we call government spending. Okay, and so this is all the stuff that government spends money on that is involved in productive activities. Okay, so it has to be productive activity. It has to produce something at the end of the day. Okay, and so this would be things like road construction, schools, national defense, and that kind of stuff. It doesn't include things like Social Security, right? Social Security isn't exactly productive. It's just a transfer of payments from one person to another. So if I said, I'm going to move this pen from my right hand to my left hand, right? I haven't produced more pens. But if instead, I take, let's see if I have $1. Yeah, here we are, right? So if I'm the government and I say, okay, I want to have another pen, so I spend money and I get another pen, right? That would count as productive activity. Okay, so if I'm moving money from hand to hand, right? That's not productive. And so that's what things like Social Security are. It's just moving money from one person's pocket to another, right? And so that doesn't count towards GDP. But anything that is productive, buying a new tank, fixing the roads, that sort of thing, that's all production, and that counts towards GDP. And then the final component is what we call net exports. Okay, and what this is it's exports minus imports, which if you understand what GDP is measuring, this sort of makes sense, because what we want to do is we want to measure how much stuff was produced in the US. Okay, and so exports, these are things that are produced in the US, right? If we produce wheat here and sell it to China, that wheat was produced in the US and we should count it towards our GDP. But if we buy, let's say, shoes from China, we didn't produce those, and so we want to subtract the value of those imports. Okay, and so there, right? Because if we counted it as production, or if we didn't subtract it, right? Then the world would look wealthier than it is, right? So China clearly counts it as exports. So we have to count it as negative imports, right? We have to count it as a negative towards our GDP. Okay, and so if we put sort of all of this together, we get a very important equation for this class, and that is Y, which stands for GDP, is equal to C plus I plus G plus NX, right? Or GDP is equal to consumption plus investment plus government spending plus net exports, okay? So let's do some work with this. So the simplest way, the simplest problem to solve for is when I give you all the components of GDP and I ask you to calculate the GDP. So let's say that C is equal to 2,000, I is equal to 1,000, G is equal to 3,000, exports will be equal to 4,000, and imports will be equal to 2,000, right? So if I give you all that, you could very easily solve this for GDP. So therefore, Y is equal to 2,000 plus 1,000 plus 3,000 plus 4,000, because we add the exports, minus 2,000, and that is equal to 8,000. Okay, so one of the tricks that I will do is I will flip these around. So maybe I'll think on multiple choice exams, for example, I'll say imports minus exports. And so then instead of getting a plus 2,000, you get a minus 2,000, right? And so you would end up with 4,000. Right, and this is what you get if you do imports minus exports. All right. Okay. Or maybe I'll do, I'll ignore this. So you'll have, let's see, 2, 1, 3, 6, 10,000. Right. So your other options would be, 8,000, 4,000, and 10,000. Or maybe I'll have them all added and it'll be 12,000. Right? And so that's how I will try to trick you, right? On your multiple choice exam with 4 choices, these will be your 4 choices, and the basic idea is I'm testing you whether or not you know that net exports is equal to exports minus imports, okay? And so that's the trick. And so obviously, if I didn't give you government spending, right, but I gave you all the other figures, you could solve for government spending just by using simple algebra, okay? But what if we want GDP to equal 9,000, right? What if we wanted to make GDP equal 9,000? How could we do that, right? Well, one way is to increase consumption or investment. But if you think about it, consumption and investment are basically all the dollars that you have left, right? These are, you either consume your money as consumption, import or investments, or as exports, right? Imports, right? And so we really can't adjust C or I, right? Because we can't really do that, right? So these we say are mostly fixed. And you might say, oh, well, we could just block imports, right? But that moves really, really slowly. And we might want something that's quick and easy to get through, right? So imports and exports, those are largely fixed. And so basically, G becomes sort of our tool, right, for adjusting GDP. And so if we wanted to increase GDP from 8,000 to 9,000, we would just increase G to 4,000, okay, or increase G by 1,000, okay? And so this is sort of the quick and dirty explanation of what GDP is. So let's talk in the next video about some shortcomings of using GDP.